I know, like, what the hell?
Welcome to UCLA Extension Department of Business, Management, and Legal Programs video lecture series on entrepreneurship, new venture formation, and strategic business plan development. The video that you're about to watch is on how to set up and develop a cash flow projection. I'm Harry Redinger, your instructor. There is a total of over 40 videos in this lecture series that all integrate with our UCLA Extension online course management program, Canvas. Each video strives to be brief and will have a bit of overlap with the other videos to lock our curriculum together. Okay, let's get started. Well, before we jump into the subject matter of developing a cash flow projection, at this particular stage in our curriculum and the mastery of entrepreneurship, and particularly in this case, the financial management aspects of entrepreneurship, there's a lot of preliminary work that we've done that lead up to this point, because we can't really develop a cash flow projection unless we've taken the time to really understand how the industry works, the cycles that the industry goes through. We also can't really do an effective cash flow projection unless we know how the market works, the level of demand. In addition, it's going to be kind of hard to do a cash flow projection without a really good understanding of our biography, company history in terms of the level of experience. Because lack of experience can attribute to business, needless to say, business failure. But the more experience we have and/or experienced resources such as a mentor, mentors, or advisory board are all essential bodies of knowledge and experiences to come in to develop an effective cash flow projection. In addition, before we get into the subject matter, most businesses work with either a specialty program for their industry or Quick and QuickBooks. But nearly all financial management programs you're able to work with them to set up your cash flow projection. And when you set up a cash flow projection within a financial management program, because as you soon will find out and probably already know at this particular point, but a cash flow projection is a projection of your income statement accounts, your revenue accounts, your direct cost of sales accounts, and your overhead accounts. And so and there's techniques which we're going to talk about on how to set projections of those up. But when they're set up and entered into a financial management program, at the close of every month, you can generate a report that shows how close you were on your projected revenues, your actual direct cost of sales, and your actual overhead accounts. And then as you become more aware of projected versus actual, now we can go back and make adjustments at future projections of overhead, direct cost of sales, etc., to be more in tune of the real life direct cost of sales and overhead. And again, we're going to share with you some techniques on how to come up with those forms of projections and interpolations. Okay, our first slide here is just a graphic fun slide that shows that we're growing our business. And if we grow our business right, there's financial growth. However, we want to be well aware that every industry has different cycles, and in particular months of the year, they'll peak. So if you have a bicycle business, you're going to have peak sales in June, July, August, September, when it's nice and hot and warm and it's a good time to go out and ride your bicycle. But you're probably not going to have great bicycle sales unless it's a Christmas present when it's snow on the ground and cold, such as in December, January, etc. By the same token, if you have a company that sells skis and toboggans and snowshoes and things like that, your peak sales will be December, November, December, January, February, etc. So all industries have cycles, and we have to know those cycles in order to do a cash flow projection. They're historical trends, and we just have to know what they are. And there's very few industries that are not subject to some form of cycle throughout the fiscal year or calendar year. I also want to put down here, we talked about this at the very introduction of our course, Introduction to Entrepreneurship, but it's the 2080 rule, or the Pietro principle. And it basically says that 20% of the population creates 80% of the jobs. And an essential aspect of being an entrepreneur, to be that person who creates the jobs, is having the maturity, the responsibility, the insight, know-how to know cash flow, to know that we have to make more than we spend to have profit. I mean, duh. But still, many people, I mean, dumb logic understand that, but do they really know how to set that up? Do they really have the intuition to know where these numbers are? And for an experienced entrepreneur, you just have a sixth sense, an intuition of where your business numbers are all the time, as well as contingency numbers, reserves, and then backup resources such as lines of credit and things like that to get you over, a tough spot. So I just want to identify that, because the knowledge and experience and capability to do cash flow projection is absolutely an essential aspect of being a competent entrepreneur. To be a member of this 20% society that creates jobs for others. Because would you like to work with a firm that does not have any awareness of their cash flow, and you're depending on that company for a consistent paycheck every month? Probably not. So in order for you to become an entrepreneur and have people trust you to make sure you're going to have a paycheck for them at the, every other week or weekly or monthly, you would want them to have that ability. This is when it comes to financial management, and there's a number of gurus out there, but one of my favorite books and concepts is Robert Kiyosaki's book, Rich Dad, Poor Dad. It really brings the light to the importance of investing in cash flows and not debt. So to be very careful not to go into a lot of debt and spend your money wisely. And to keep your financial ratios in balance with the norms of the industry. There's audiobooks of this. That's a great read, and it just really wakes you up to the reality and importance of not only financial management, but a mindset of where and how you put your money. The people who really, really make it financially just have a sixth sense of where and how much to put their money. And they also have a certain sense to them about the way they spend money, in terms of, not spending money on things to keep up with the Joneses, but spending money on things that make money. And so, and even if they've got millions of dollars of discretionary spending, they still are more apt to have a plastic watch and not some stupid $15,000 Rolex watch, even though they could buy it no problem, but they just don't, it just doesn't make sense to spend money on those kinds of things. And the person who does have the $15,000 Rolex watch probably has financial problems because of just not logical spending of money. Conservative spending money. But our goal is to do a cash flow projection that manages the cycles of the business. Okay, so the first step in projecting your financial cash flow is to master your income statement accounts. Now, the last few videos dealt with an introduction to financial statements, and then how to manage your financial management system, and setting up QuickBooks and file systems and things of that sort. Now we're at a point in our curriculum where we want to master the art of projecting our revenue into the future. Things change, but if we do a projection, we're more sensitive to what the actual numbers are. So when we open up the telephone bill and look at the bottom line for what it was, we have in the back of our mind what we projected it to be. Was it above or below? If it was above and significantly above, oh my gosh, this might have a hit on my bottom line. Same thing when you work with a payroll company and you get your payroll in, and you have a report that looks at your payroll distribution for your different departments, and then you can compare that against your projected payroll for your departments, and you realize it's up or down, and then you have to ask the question, well, how are did my revenues go up? So as my payroll went up, did my revenue go up? If not, and went the other direction, you go, wow, we better really start drilling down and get the magnifying glass out and take a look at, do we have a problem? Do we have to cut expenses, or do we need to put more emphasis on increasing our revenue so that that we're passing our break-even point and we're still achieving our minimum projected profit margins? Anyway, your cash flow projection is a projection of your monthly income statement, thus a projection of your income account statement, meaning a projection of your revenue accounts or your profit centers, a projection of your direct cost of sales accounts, and as we talked in previous videos, for every revenue account, we want to have a corresponding direct cost of sales account, because otherwise we could be bleeding. We could be losing money per a revenue account and not know it. So if we're going to put money into a revenue account, we best should compare the revenue that comes in comparison to the direct cost of sales of money that goes out, and hopefully a whole lot more money comes in than money goes out. If not, we might want to cut having a particular revenue account and stop producing a particular product or service because we're losing money doing it. So how we set up our financial statements and do cash flow projections gives us insight on whether we're making or losing money per our profit centers. And of course, our overhead accounts. And overhead accounts are sometimes the hardest to project because it's just a lot of experience comes in here, and there's always lots of financial surprises that we're dealing with sometimes. Okay, our cash flow projection. In the overall scheme of developing a business plan or developing a business model and setting up a business, this is step 9 out of a 10-step process. So we're almost close to the end in setting up a business plan, a business entity. So how to conduct a cash flow. So here's a basic income statement. Now, an income statement is going to be revenue minus expenses, and sometimes expenses, direct costs of sales, are integrated together, such as in this particular report. But our revenues are $27,800. Our expenses are $14,850. So we have a net income of $12,950. So now we're going to take a look at this from another point of view. Here's a business called My Art Business, a sole proprietorship. And we can see sales, revenue, and we can also see the profit centers, the categories of sales here: original art, limited edition prints, and frames. And so we have a total there of $52,900. And then we have cost of sales. And so here are our direct costs of sales, and that came in at $11,650. And so our gross profit is $41,250. And then we have to take our indirect cost of sales, our overhead, into consideration. And here we have advertising. These are things that we can't track back to a revenue account. So I have advertising, studio rent, studio utilities, etc. And that comes to a total of $6,150. And then net income before taxes is $35,300. And then income tax, $4,000. Net income after taxes, $31,100. Okay, an important part about an income statement, it's per a fiscal year. It's not running on and on. This is the profit per this fiscal year. So if the same company did a balance sheet. And balance sheet stuff is not a part of conducting cash flow statements. But just know the balance sheet balances go on. And when you do a balance sheet, it's the value, the worth of the company at any given time. So it's assets minus liabilities equal equity plus this number down here, this $31,100. And so they have the total value of the company in terms of equity. And then we can take this, and then off to the right here, we have a shell outline of an income statement: revenue minus direct cost of sales minus over. It's the same thing. And basically, you are going to need to and want to set this up in your accounting QuickBooks system. And all systems allow you to put projections of those in. So we can go to... some systems have tools to help you to project it, but we often set our cash flow projections up in QuickBooks. And as I've mentioned in earlier presentations, lynda.com, lynda.com has fabulous. For $24 a month, you have access to all their educational videos, but it's a fabulous resource for computer program educational videos. On how to work with QuickBooks and or how to work with Excel in this particular case. But our goal is we need to understand our income statement accounts, our revenue accounts, which are our profit centers, minus our direct cost of sales. How much money did we spend to make a profit in that profit center, minus our overhead, and that is our profit. Okay, so here we have sales revenue of 400 accounts, direct cost of sales accounts, and that equals our gross profit. And now also note that these ratios and percents here, as we get further into the subject matter, we're going to get exposed to industry average ratios and ratio analysis. And so just that's something that, because we want to make sure that our expenses, and we use these ratio analyses sometimes to do cash flow projections. And then again, we also have our general selling and administrative expense. If I backspace, there's our revenue and our direct cost of sales, and then here's our overhead. And again, there's our bottom line here, our net income after taxes of $31,100. So that's a blow up on that last report. Oops, maybe it's going the wrong direction. Here we go. Okay, so here's this is my favorite format for doing cash flow projections. And it's an Excel spreadsheet, and it's not that hard to learn how to set this up graphically as well as mathematically. But from a graphical standpoint, we want to develop a bar chart going across the top. And then underneath the bar chart, we want to have 12 columns for the calendar year, and then a 13th column to have the totals for the year. So we can take per revenue account the total annual revenue per each profit center, and then we can also have the total annual costs that we put into telephone and overhead, direct cost of sales, etc. And what I like about this particular approach to doing cash flow projections is that at the top where we have phase 1, 2, 3, our phases of our competitive strategy, we're now able to integrate the competitive strategy sections and mechanical sections, if you will, into the projection of our cash flow. So all the work we put into developing a phase 1, 2 strategy, and then by projecting this strategy from a bar chart standpoint, calendar months, that's going to be dedicated to phase 1, 2, 3. And phase 1 might be business setup, so there might be 0 financial transactions or only overhead account financial transactions taking place during phase 1, and no revenue, no direct cost of sales, but a negative cash flow. So we can use this form of cash flow projection to also understand from the standpoint of business overhead, what expenses are we going to be dealing with before we even have cash flow? So we're going to have negative cash flow. And this tells us how much has to be funded, how much startup funding that we need to pay for the negative cash flow aspects of our cash flow before we start having actual revenue cash flow and surpass our break-even point. So the beauty of this is we have our competitive strategy across the top. And then from there we have specific knowledge based on that in terms of our market development program strategy that's outlined in great detail in our mechanical sections, that we can now start to make some kind of projection on sales per revenue account. And then for our direct cost of sales account, we go to Standard & Poor's or Dun & Bradstreet, and there are standard percents of revenue that are attributed to direct cost of sales in all industries. So by looking up the SIC code and finding your specific industry and usually they break it down in small business, intermediate size, and large businesses in the industry, we now can look up what percent of revenue is attributed to direct cost of sales, and we can put that in. We can also get a feel for at national averages in terms of what percent of revenue goes to overhead. And of course, it's always good to really know what real overhead is. But if you had to just take a statistical approach to this, we can find this information all by taking the SIC code of our industry and going to Dun & Bradstreet, Standard & Poor's, and there's a number of other financial reporting type institutions that give national averages on what these numbers are, and then we can use those to project these numbers based on what our projection of revenue is. So here's a template of how to set up a cash flow projection, and now this is an actual spreadsheet, and I know it's you can't even read the numbers to give you an idea. But this is a real live cash flow projection that's done for, I believe it was a retail clothing store that I did some time ago. And so at the top, we have our phase of competitive development, and then we have year one, or what's left of year one, then year two and year three. And so we have our revenue accounts, and we're gonna drill down into that. But you can see where the revenue counts are all the ones that have these little black boxes across there, because the first line will show the number of units so each line there represents a revenue account. But the way this is calculated, we have a line across the top that says the units of that revenue account that were sold, and then that times a price per unit, and we're going to expand this in a second. And so it's a way, by setting up your spreadsheet this way, it's not too hard to set up Excel to do a growth equation so that we can make that revenue account grow a particular percent every month, and then we can also make it decline a particular percent every month for the down portion of the year from a cash flow standpoint. So let's take a little blow up now of our revenue count. And now we can start to see that we have shoes, menswear, tees, t-shirts, etc. And it's still kind of hard to see, but the top part is the number of units sold per month, and at $41 per unit, and then we have the units up there, and then it puts the revenue below. So it's not that hard to figure out how to program Excel to do those kinds of cash flow projection growth projections for you. So projecting our revenue accounts, you can see here there's a blow up of 190 units times $55.43 will equal $10,532. So that's how we set that up. And again, a lot of this comes from just experience in the industry of what you expect to sell. Even if it's off, it's a starting point. And the more you're in the business, in the market, the more these numbers become more predictable. And the more you know these numbers, the more you can read the newspaper and get a feel for the economy and and know where these numbers are going to come out every year. And so we can also see the relationship of these numbers to the phase of competitive development. Now we're going to take a look at the direct cost of sales accounts, and here now these are all 500 series accounts. Revenue accounts are 400, so these are all 500 series accounts. And again, I have done the logo of Dun & Bradstreet and Standard & Poor's, so we can look up and see what percent. And by merely taking a percent of the revenue, we can put that down here in terms of direct cost of sales accounts. And then when we put the stuff into QuickBooks and then develop reports that says projected versus actual, then we're going to start to see, how close we were to these projected, and then in due time, we can start actually using our own percent projections of what these numbers are. Our overhead accounts are a little hard to project, and this is where experience comes in. But here is where we put, when you set these things up, you got to be careful not to have too many overhead accounts. It's real easy to get crazy about this and have an overhead account for paper clips. We'll just call it office supplies. And instead of having 5 different accounts for shipping, in terms of UPS and FedEx and US Mail, just have one called shipping and delivery. Try to keep the number of overhead accounts manageable, because some companies just get really crazy and you get way too many of them. It's just from a managerial standpoint, try to keep this so it's within like 15 or 10, because it's real easy to get too detailed here. Then anyway, the overhead accounts gives us some kind of idea on, and we have a lot of control over these things too, but what the overhead that's necessary to keep the business running. And again, the use of the accounting equation and unlocking QuickBooks, the more we study the details on our business and how it works and knowing our business by the numbers, the better we are at projecting our cash flow. And everything boils down to the number, the net profit, the lower right-hand corner of our cash flow projection, because when investors in the business, they want to know what they're going to get out of it in 3 to 5 years, and so they're particularly going to want to know what your assessment of this is. Now, always know you can make anything happen with an Excel spreadsheet, and so it's real easy to have numbers that are, falsely or maybe unintentionally, but are inflated out of reality. I've done many spreadsheets where, it looks like we got a multi-million-dollar business going on here, unaware of just, the market demand isn't there. It's too abstract of a concept. People just aren't going to buy it. So it's kind of tricky to do this, and this is why sometimes it's good to have an advisory board or mentor or hire consultants to come in and help you be a little more realistic on how to balance and adjust these things. Know that when you get your head into developing a cash flow projection like this, and you absolutely have to do this to know your business, it's amazing the amount of time that you can put in this. The very first clip you do, you're either making an unrealistic amount of money or you're not making any kind of money at all. So now you got to come in and just start adjusting the revenue and direct cost of sales to the point where it's as realistic as possible. know that in the world of accountants and financial management, there's accounting firms that specialize in particular types of industries. And so once you get your first draft up going, and if you can afford it, and I truly hope you can see the value in it, but this is an area where it might behoove you to go see a CPA and say, do my numbers look, based on my experience and what I'm doing as a business, do these numbers look half-ass realistic? And get that kind of feedback on it, because if they're not, you want to find the reality of your numbers out before you launch your business. You don't want to be struggling and find out the hard way that you were way off on what you thought your revenue accounts are going to be. So bottom line is, we want to get down and to be able to forecast what the total annual revenue will be on an annual basis, and trying to find that, we've launched and we are established in the marketplace, and that we can pretty well, in this case, predict year after year after year, we should have like a $683,000 profit margin at the end of the year, after debt payments and all that kind of stuff. Also, when we do a cash flow projection, it's important to do some kind of SWOT analysis. What are the strengths, weaknesses, and threats and opportunities relevant to that cash flow projection? Because it might be overstated, understated. So it just always keep that in the back of your mind. The SWOT analysis aspects of your cash flow projection, and having maybe a scenario A, a scenario B, a scenario C, all could be possible outcomes, but you might want to take one cash flow projection over another that might be more realistically based and aligning with the realities of your business. So know when to hire and delegate to an outside source as your business grows. And one of the key things to do is you have to know as your business, you have to know when to start working on the business versus in the business. And when you start working on the business, you're going to have to start hiring people or outsourcing tasks such as bookkeeping, accounting, and the things you really, really hate to do. But that might be key from physical health, mental health, psychological health, to delegate certain things that just bog you down. So you've got to know where your comparative advantages are as a business person. And for many people, it's not really doing accounting and financial management. You've got to know this stuff. But it can be a huge time sink. And what might take you a half a day or a day to do, an experienced bookkeeper can do in 30 minutes. So, and they charge maybe, $50 an hour or $75 an hour. Why lose an entire day? That's a good fee to pay to have the stuff done for you, and it's already set up, and you don't have to, commiserate over it. Anyway, that wraps up our little talk on how to develop a cash flow projection and the importance of knowing this kind of information as you grow as a business. See you at our next video lecture.